As regards completeness, this is also a common question. The question would give you the definition of completeness, and your choices would be different terminologies. And again, if you can just understand English, then you would be able to conclude that the answer should be completeness. That is the type of question that gives students the false sense of confidence or security that they can survive accounting without studying. So, completeness, information is complete if it includes all information necessary for a user to understand the phenomenon being depicted, including all necessary descriptions and explanations. If you will read this in the question, then definitely you can easily conclude that the answer here should be completeness. But how then do we apply the requirement of completeness? When can we say that a depiction is complete? As a minimum, these three things must be present: a description of the nature of the assets, a numerical depiction of all the assets, and a description of what the numerical depiction represents. So the first one, a description of the nature of the asset, this can easily be complied simply by the account titles that we use: cash, accounts receivable, property, plant and equipment, land and building, so on and so forth. Second, in numerical depiction, this is complied with the monetary amounts that we present in our financial statements. While the third one is a description of what the numerical depiction represents. Normally this is complied in your notes to the financial statements, whether the amount presented in the financial information is a historical cost, a fair value, or some other measurement. So actually, the requirement of completeness for financial information is easily complied with in the financial reports simply by the use of common account titles, by presenting the amounts representing the values of those assets, and by providing the necessary disclosure in the notes to the financial statements. However, there are some assets and even liabilities that will require more information for the depiction to be considered complete. Aside from the account title, the amount, and the disclosure of the valuation, some assets and liabilities will require the next three items in the slides: explanations of significant facts about the quality and nature of the items, factors and circumstances that might affect their quality and nature, the process used to determine the numerical depiction. One good example for this one would be your estimated liabilities, especially for your estimated liabilities from pending litigation. The company has an ongoing case against a third party, and based on the opinion of your lawyers, it's possible that you may have to pay the other party. But while the case is still going on, it's impossible for the entity to actually know how much it is going to pay. But there is already a reasonable belief that the entity will ultimately become liable. As early as now, the company is required to recognize the liability, but the problem is as to what amount. Information regarding liabilities from pending litigation is definitely relevant. But the problem is there is a challenge in making sure that the financial information complies with the faithful representation requirement. So if the entity will report an estimated amount to comply with the faithful representation requirement, then the entity should provide additional information. How did you come up with the amount? Who came up with the estimate? How was the estimate determined? What process was used to come up with the estimate? All this is for us to comply with the requirement of completeness. So for assets that do not require estimates or judgments, then the requirement of completeness can easily be applied with. The need to provide additional information arises when the asset we intend to report involves heavy estimates and judgments. Another example would be for entities that provide warranties to their customers. All your customers are entitled to the warranty, but not all of them would be availing of the warranty because they will only avail of the warranty if ever there are problems with the products that they have purchased. So if there is no problem with the products, then definitely you will not have any warranty cost. But the problem is you are required to recognize your warranty liability because of the chance that you would eventually become liable. So your problem now is on the valuation of your warranty liability. And because of the nature of such liability, it is not enough that you just present it together with your other liabilities with an amount that does not have any sufficient basis. In such case, the entity should provide additional information. It should provide an explanation of significant facts about the quality and nature of the liability, factors and circumstances that might affect the amount and nature of the liability, and the process used to determine the estimated amount. Now, as for examinations, even from this side alone, this can be converted into a multiple choice question. Which of the following is not always needed so that complete depiction may be achieved? And the answer would be any of the three last items in this slide. Because again, the first three are what we consider as your minimum and therefore sufficient for some assets. The last three in this slide would only be needed for some type of assets, especially those that require estimates or judgments. By now, you should have already an idea on how questions are developed. You will just be given with four choices, and three of the four choices belong to the same group, one way or another, and you will just be asked to identify the odd choice. So here we can actually come up with two questions already. Which one is always required or which one is not always required? And that may be the question that will come out in our exam. The second element of faithful representation is neutrality. Neutrality requires that there is no bias in the selection or presentation of financial information. That information is not slanted, weighted, emphasized, de-emphasized, or otherwise manipulated to increase the probability that financial information will be received favorably or unfavorably by users. So again, if the question will just give you this definition, it will not be difficult for you to come up with the conclusion that the term being described is neutrality. That's a question that you should take advantage of. Important note mentioned in the framework, though, is that when we say that neutrality is required, we do not mean that information must be capable of influencing behavior of our financial statement users. If that were the case, then that would already violate the requirement of relevance. What the neutrality requirement is trying to prevent is that you willingly or intentionally present information because of a desired reaction from our financial statement users. The preparers of the financial statement must not be working on an angle. They should not have a desired reaction from the financial statement users. So the test here would be whether or not the financial statement users were able to come up with their own independent decision. If you presented the information with the goal of transferring your own plans to the financial statement users, then you already violated the requirement of neutrality. Information must not be used to manipulate the actions of our primary users. Also, in order to achieve neutrality, entities must exercise prudence. And prudence is the exercise of caution when making judgments under conditions of uncertainty. When we say we are being prudent, we make sure in cases of uncertainty that we do not willingly or intentionally allow our assets, liabilities, income, and expenses to be misstated. So prudence is actually an interesting concept in the framework. Based on the old framework, prior to the 2010 version of the framework, prudence was actually given the same prominence as your neutrality, the same amount of emphasis as your neutrality. And I think it was the 2010 version that removed prudence from the framework. And prior to the 2018 version, there was actually a call to bring back prudence as part of the qualitative characteristics of a financial information. So to expound on prudence, it's important for us to discuss the two types of prudence, which is your asymmetric prudence and your cautious prudence. Most books do not discuss this because these two are not discussed in the framework. I got this from the notes from the meetings of the IASB when they were trying to develop the 2018 framework.